Welcome to Chapter 20, Charlie Munger's second rule of investing. A stock must have a long-term prospects. In this chapter, we have three objectives. The first objective is how to identify a company with a long-term prospect. The second objective is understanding what the capital gain tax is. And the third objective is what is the difference between a short-term gain and the long-term gain. So let's get started. Okay, so here we are at the second rule. A stock must have a long-term prospects. So as we look at these four different items up on the screen, let's go item by item and let's predict whether this is still going to be something that we see in 30 years from now. So the year in 30 years from now is year 2054. So when you envision the future in 2054, do you see people still using cash? I think everyone can agree that the use of cash will be drastically reduced by 2053. Now, when you look over the next item, you see chocolates, candies. It is pretty obvious that we are probably still going to be eating chocolates, candies 30 years from now. So, let's go down to the next one. When you look at the manual transmission cars, so let's say you had a company or you want to own a stock or a company that only made manual transmission cars. If you're making only manual transmission cars, do you think that the business model would still be viable or sustainable 30 years from now? Then the last one is, let's say you own a business that made cell phones. There is probably a good chance we are still going to be using cell phones 30 years from now. So when you look at these scenarios, these examples that I have here, it's not that we have foresight beyond recognition. We are just really looking at the application of what something is and whether we still feel that it is going to be around. And whenever you're buying a company and you're looking at their primary product, like let's say for example, C's Candy, are we still going to have C's Candy company? Yeah, that's still going to be around 30 years from now. So when you look at investing, General Motors is an unbelievable car manufacturing company. I love their product. I would probably have a very difficult time buying their stock simply because I have no idea if that company is still going to be the number one car selling manufacturer in 30 years from now. I'm not sure. So when we talk about long-term prospects, this is what we are really talking about. And this is the assessment that you have to do regardless of how much you might like a product or like a company. So when we talk about long-term prospects, this is what we are really talking about. And this is the assessment that you have to do regardless of how much you might like a product or like a company. So predicting which companies will be around in 30 years is impossible, but ones that won't be around is a little bit easier to predict. So why do you want to invest in a long-term company? Why don't we want to invest in a car manufacturing company like General Motors and hold that company for a year and then just sell it off after we made our money? There are two main reasons why you want to buy a company and hold it in the long term. The first reason it's kind of obvious is because if that company has sustained earnings and it's going to keep making money, well, then it's going to continue to put money in your pocket either through dividends or through the growth of the company as its equity. The second reason is the one that a lot of people really don't understand, and it is taxes. Okay, so I'm going to give you a really good example here to demonstrate why you really want to buy a company and hold it for as long as you possibly can. Okay, so in 2024, this is going to be new capital gains tax bracket. If you don't know what capital gains are, if you buy a stock for $100 and you hold that stock for let's say 6 months and the stock increases in value to $200 and then you would sell it, you just made $100 profit off of the market price of that stock. Because you bought it for $100 and you sold it for 200 in that 6-month period, that gain you are going to be taxed on. That $100 gain that you just made is what you are going to pay taxes on. Now the tax amount depends on what income bracket you are in and how long you held that asset or the stock. Since you held it for 6 months, in this case, that's considered a short-term capital gain. If you hold it longer than a year, that's considered long-term capital gains. This is 2024's capital gains structure. Anything over 1 year is taxed at different rate. So the longer we hold it, you can see on the chart, there is less we pay in the taxes. Now for the scenario that I described, where you made $100 profit on a company in 6-month period, depending on what income tax bracket you are in, let's just assume you are in a highest tax bracket, which is 37%, you would pay 37% taxes on that gain. Now if you would have held a stock for over a year, you would have been in the 20% tax bracket. Now you saved 17% tax just by holding the stock more than a year. So let me go ahead and demonstrate how painful the short-term taxes are for whenever you buy and quickly sell a stock. Let's assume that you had $50,000 and you invested that $50,000 at 10% investment return. I am just using that number to make it little easier, I guess. You are going to hold that investment for 20 years. So every year that investment is growing by 10%. And then we are going to assume that you will sell it at the end of 20 years and you are going to pay your taxes. And to see how much money you would have made. So you can see after 1 year, your $50,000 would have turned it into $55,000. And then after 2 years, it would have turned into $60,500. And you keep going down the chart, you are not paying any taxes on any of that growth. You are not paying any taxes on, and that business is just continuing to grow, and that's due to the equity, and that's also due to the dividends. Okay, now you will pay taxes on dividends only, on the income of those dividends, but as far as the actual growth of the market price, you are not going to pay any taxes for the 20 years. If you would just continue to hold it now, if you continue to hold that for the rest of your life, you just take the dividends and you would never pay any taxes on that market price growth of that company. So whenever we arrive at the 20-year mark, you can see we end up with $336,375. And let's assume that we sold it right at the 20th year mark. We are also going to assume that we are in the highest tax bracket, which is 20% for long term. So after we held that security for 20 years and after the 20% tax minus, the number that we came up with goes down to $269,100. And the taxes that we would have paid would be $67,275. That's a lot you are going to pay in taxes, but you also made a whole lot of money off of that $50,000 investment. And that's primarily because of the large 10% yield. Let's look at what happens if we are constantly selling and buying, but we are still making the 10% profit every year. So same exact scenario, we are going to invest $50,000, but in this scenario, we are going to go ahead and sell this stock right before 1 year mark, and we are going to pay that short-term capital gain tax. Okay, so the person who is out there doing the day trading, the person who buys a company, holds it for 3 months, and then sells it and buys something else. This is the person we are describing here. In this scenario, that $50,000 after the first year is going to turn into $53,150, half of a 10% gain. So after the first year, we would have been $55,000, but then you would have paid that 37% tax on that $5,000 gain. So what I'm showing you is after the 37% tax gain paid, okay? So that even though you made a 10%, you only have $53,150 after the first year. And then after the second year, you can see it is $56,498 and so forth and so on. As you go down, clear down to the 20-year mark where you have a $169,681 at the end. The taxes that you would have paid over that entire 20 years will be $70,289. So here is a perfect example of a person who would be investing. This is assuming they can continue to put their investment into a 10% yielding return every time they trade it. Okay. So let's compare these two. On the left, we had a person who bought the company that was continuing to grow at 10%. So that investment turned into $269,100 after you paid your capital gain tax, and you paid $67,275 tax. And over on the right, you have a buy sell buy sell buy sell strategy, and you only have a $169,681 in that investment, and both of them were making 10% every year. So you're talking more than $100,000 difference over the time of that single investment period. The irony that I see is that when you look at the taxes that are paid, the taxes that the person paid were actually almost similar, but the amount that you have in your bank account is drastically different, $100,000 difference. So this is the Charlie Munger's second rule, that a stock must have a long-term prospects. And the reason that he likes the stock to have a long-term prospect is because he does not have to pay as much in his taxes. He is avoiding paying that enormous capital gain tax by not trading it every other month or every few months. He is holding these companies with the intent to own for the rest of his life, because he is going to continue to collect the dividends, and the market value is just going to continue to increase, and you won't have to pay the taxes on it. So this concludes our second rule. A stock must have a long-term prospects. Anytime you find yourself wanting to buy a company in the short term and quickly flip it for some money, you are definitely going to want to think about this rule and how the pain of those taxes eats away your gains. So this concludes chapter 20, Charlie Munger's second rule, where we talked about a stock must have a long-term prospects, and we talked specifically about capital gains tax, and the three objectives were how to identify a company with long-term prospects, what is the capital gains tax, and what is the difference between short-term gain and the long-term gains. So I hope you guys learned a lot, and I will see you in the next chapter where we talk about Charlie Munger's third rule.